Welcome to The Explainer. Today, we're diving into a massive paradigm shift that's currently transitioning the entire AI industry from speculative hype to a rigorous show me the money phase. Because, we really have to ask, what actually happens when the math stops adding up? OpenAI just missed its targets, and a $600 billion data center bet is starting to shake. We are entering a brand new era of AI investing right now, and the landscape is shifting under our feet way faster than anyone predicted. All right, let's just jump right into a seriously jarring reality check. $600 billion. That number represents the staggering Stargate data center infrastructure bet that's currently shaking up the entire tech sector. We're talking about the projected U.S. big tech investment for 2026. That is a 50% increase from the previous year. To put that astronomical number into perspective, this level of capital intensity more than doubles the peak of the 1990s internet build-out. It's essentially the cost of building a brand new national highway system, but for data. The sheer scale of capital being mobilized here is literally unprecedented in modern economic history. But now hold that $600 billion infrastructure commitment up against this incredibly tiny sliver. $20 billion. That's OpenAI's current revenue run rate. And wow, does this highlight a massive, terrifying gap between capital expenditure and actual return? The math here is incredibly sobering. OpenAI is burning through cash, facing a projected $14 billion loss in 2026 alone, and cumulative deficits, those could potentially reach $143 billion. So the short-form pivot here is absolutely undeniable. The cost to build the machine is drastically outpacing the money the machine actually prints.
And this cash flow crisis is becoming almost impossible to hide. When OpenAI CFO Sarah Frier is privately expressing alarm regarding the company's ability to support its massive data center spending and even floats the idea of federal loan guarantees, that is a glaring red flag. I mean, they're essentially asking taxpayers to underwrite the infrastructure build-out. When the AI king is missing internal user growth targets, facing increased subscriber churn, and burning cash at a rate that requires quiet conversations about government bailouts, well, it strongly signals that the current business model is practically unsustainable without massive outside intervention.
So, to unpack this entire rotation from LLM hype over to execution-based AI, here's our roadmap for today. We'll cover the growth ceiling reality, the CapEx to revenue trap, beware the middleware squeeze, the agentic software pivot, the zero-sum cloud war, and finally, the brutal truth. Let's get into it. Section 1. The growth ceiling reality. The great re-rating. We are officially shifting away from that NVIDIA moat phase of speculative buying. We're at the exact point where the raw power of large language models hits the hard wall of operational reality. And that is forcing a brutal re-rating based on actual revenue generation. The crucial terminal data point here is this widening disconnect. Aggregate hyperscaler capital expenditure is surging from $380 billion to as high as $700 billion. That's up to an 84% jump. Meanwhile, OpenAI's revenue run rate is lagging way behind, crawling from $20 billion to maybe $30 billion. The capital required to build the infrastructure is completely decoupling from the revenue generated by selling the software. It's creating a total economic black hole. Section 2. The CapEx to revenue trap. Infrastructure fallout. This builds directly into what analysts are calling the CapEx to revenue trap. It's an infrastructure fallout that will absolutely crush undercapitalized companies by 2027 if they can't bridge the gap. The recent cancellation of the 600-megawatt Abilene data center expansion perfectly exposes these structural fault lines. This flagship Texas campus was supposed to grow from 1.2 gigawatts to 2.0 gigawatts, costing around $15 billion. But negotiations completely collapsed. Why? Well, because a 2.0 gigawatt facility requires the equivalent energy of powering a mid-sized American city. Local utility grids are flat out rejecting these proposals. You've got OpenAI's constantly changing demand forecasts, intense financing constraints in a high-interest environment, liquid cooling technologies completely failing to meet early targets, and utility-scale power grids that simply cannot support the physics of these mega facilities. Section 3. Beware the middleware squeeze, the risk stack. Now, we need to talk about who is actually making money here. This is where we see agentic decay in action, literally splitting the market into a 3-layer risk stack. As raw inference becomes a cheap commodity, the real value is shifting entirely away from the middle layer. Down at the bottom, infrastructure owners like Google and AWS collect rent regardless of who wins, with Google Cloud enjoying 30% margins. In the middle, you have frontier model labs like OpenAI, bearing all the multi-billion-dollar training risks, but they're just selling tokens at capped margins. Actually, some analysts are calling them the pets.com of this cycle. Companies spending absolute fortunes to build massive brand awareness, but lacking the unit economics to actually survive long term. But look at the top. Vertical applications like Cursor and Harvey are capturing the actual workflow lock-in, generating massive SaaS-like margins while only paying for the super cheap tokens they consume. I mean, Cursor hit $2 billion in ARR in just 33 months. Why? Because they own the execution, not the plumbing. Section 4. The Agentic Software Pivot, Investing in Execution. This leads us to the absolute revelation of 2026. The real alpha right now lies in identifying the winners in execution rather than just inference. We are actively shifting away from simple conversational chatbots to autonomous agentic software that actually does the work. Amazon is a perfect example of this. They are bypassing the chatbot phase entirely to enter the $300 billion enterprise SaaS market. Their Connect Talent AI agents don't just sit around and assist HR workers. They actually execute core logistics behind the scenes. Think about what that really means for a second. An AI didn't just write a nice job description. It actively found the candidates, screened their resumes, conducted the preliminary interviews, and finalized the hiring for 250,000 seasonal workers. That is software replacing the human element entirely. Welcome to what Wall Street is officially calling the SaaS apocalypse. Traditional per-seat software licenses are collapsing. Because really, why pay for 1,000 Salesforce seats when a single AI agent can now orchestrate tasks across competing platforms like Microsoft 365, Google Workspace, and Slack? Think about the underlying financial math here. If one autonomous agent effectively replaces 10 human SaaS seats, the traditional software business model simply breaks. This realization sent shares of Salesforce down 30% and ServiceNow down 39% earlier this year, as investors suddenly woke up to the massive threat of agentic disruption. To truly understand why this is happening, we have to look at the massive technical shift driving it. Standard LLMs, like your typical ChatGPT, are stateless. They require a human to sit there, prompt them, fix their hallucinations, and essentially hold their hand through every single step. But the new standard, something like the OpenClaw agent, is stateful. It doesn't wait for you. It's an actionable, programmable digital worker that can open your local file system, navigate your browser, and execute tasks independently with incredibly high reliability. We are migrating away from reactive prompters to proactive executioners. Let's walk through the exact software engineering of this agentic loop because it's fascinating. Imagine telling an agent, hey, balance the Q3 budget. It starts with intake, pulling your initial command from a channel like Slack. Then it moves to context assembly, where it runs off and gathers all the necessary financial files. Next, it uses model inference to decide on the mathematical actions required and actively performs tool execution right there on a local machine, literally crunching the numbers in Excel itself. And then, crucially, it performs inspection and persistence. Using a lane-based command queue to prevent infinite loops, the agent continuously observes, acts, and inspects its own work until that Q3 budget goal is officially met and verified. It's a real game changer. Section 5. The Zero-Sum Cloud War. Microsoft versus Google. As this agentic technology evolves, the battle for dominance is becoming a cannibalistic zero-sum game, pitting Microsoft heavily against Google. And right now, Google is gaining massive ground. Why? Because they own the entire vertically integrated stack. They have their own silicon with Ironwood TPUs, their own runtime with Gemini, and billions of users on Workspace for immediate distribution. But their absolute secret weapon here is the A-to-A, or agent-to-agent protocol. This allows an agent built on Salesforce to seamlessly hand off a real task to a Google agent, which then queries a ServiceNow agent. Because Google is architecting this interoperability layer, they are bypassing traditional software silos entirely. This is exactly why Azure's base business, without AI, is growing at its slowest pace in a decade. Microsoft is simply being outmaneuvered in the agentic routing layer. Section 6. The brutal truth. Retail momentum versus institutional reality. We've reached the final section of our explainer, and it's time to confront the terrifying gap between retail assumptions and institutional strategy. The brutal financial grounding of all this is the ROI disconnect. Despite trillions in spending, MIT found that 95% of AI pilots deliver zero measurable impact to the profit and loss statement. Zero. And S&P Global reported a 42% discard rate for AI projects in 2025. Why is this happening? Because companies are quickly realizing that paying for expensive API calls just to write slightly better emails doesn't actually move the needle on corporate profit margins. Traditional enterprise AI implementation has an abysmal failure rate due to a severe lack of ROI discipline. The market is finally demanding actual outcomes over speculative moonshots. And yet, if you look at the market behavior, 90% of retail investors are still momentum-chasing LLM providers. They're blindly buying into the old 2024 narrative of inference moats and completely ignoring the impending capex to revenue lag. But the smart money, the institutional capital, has already recognized the growth ceiling. Listen carefully, this capex trap will absolutely crush companies with weak cash flow by 2027. The institutions know this for sure, which is exactly why they are rotating out of foundational models and pivoting entirely into agentic software. So as we wrap up this briefing, I want you to look at your own portfolio. Consider the massive infrastructure numbers we unpacked today, and ask yourself this one critical paradigm-shifting question. Are you investing in the execution, or are you just funding the infrastructure? Because in the show me the money phase of AI, only the ones actually executing the workflows are going to survive. Thanks for joining me on this explainer, and I'll catch you on the next one.